Hey guys, Akil here. Welcome back to the Trading Coach Podcast. In today's episode, I'm going to give you 2 reasons why you need to demo trade. Now, before we hop into the podcast, if you are brand new, thank you for checking out the show. My name is Akil Stokes. I'm a professional trader. I'm also a trading coach over at www.tier1trading.com. If you like what you hear in this episode, I recommend you take the 10 episode challenge, which means you listen to 10 random or specific episodes of the Trading Coach Podcast. And if you find that this is helping you along your trading journey, then become a regular listener as we release 3 new episodes each and every week. Now, I haven't spoken about demo trading in a very long time, so I don't know what the street kind of thinks about it right now. And by the street, I mean socials, right? But back in the day when I was heavy on social media, I mean like actually involved in tweeting things and listening to people and having lots of conversations, demo trading was frowned upon. Now, take that with a grain of salt because most traders on these social platforms or on trading forums aren't actually real traders. They are people that are pretend traders or people that are just trolls. They come on to kind of make people angry because that's their job. So when you hear these negative kind of reports about demo trading, take it with a grain of salt because that's what these guys are doing. But the understanding that was back then was like, Akil, why should we demo trade and waste time when we can be real trading and making money? And the easy answer is that most traders don't actually make money. You go broke pretty quickly, and that's why you should demo trade to kind of test it out before putting any live money at risk. But that would be the sensible thing to do, and most traders aren't sensible. Now, again, that was a very long time ago. I don't know what the feel about demo trading is now since I don't really kind of involve myself in those circles much. But if you were curious, I have 2 kind of warnings that demo trading will help you work through. And I had 2 questions that came up from different people in the last week or so. One was talking about dealing with spread. It was a trader that really kind of just went live and was looking at the difference in his live trading results versus his demo results, meaning like your actual orders getting filled. In many demo accounts, and I haven't been on demo accounts in years, so I don't know if it's like this or if it's more accurate now, but when I demo traded a very, 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 very long time ago, almost 2 decades ago, there were no spreads, there were no commissions, there were no fees, meaning that when I entered an order at a very specific price, I was filled at that exact price. When you trade live, you have to either pay commissions and fees or pay a spread, which means that when you enter an order at a specific price, you're most likely getting filled at a different price. So for example, if I want to be a buyer, if I want to get long the euro dollar and the euro dollar is at 110.02 and I buy it at market, I will probably get filled at 110.04, right? That's the spread is those couple pip differences. That's how the brokers get paid. And why it's important to know the difference is this. Now, if you're a longer term trader, probably makes 0 difference, right? There, the spread is going to be marginal in your bigger kind of deal, right? If you're taking 50, 100 pip target profits on the trade and you're paying 2 in, 2 out, maybe 4 pips total because of the spread, 96 pips versus 100 pips, not that big of a deal. Not quite an accounting error, but not that, it's not going to shake up your trading. However, if you are a lower time frame trader, if you're perhaps a day trader, this could have a massive effect. And I remember that when I was day trading, I had created this strategy on the range bar charts, right? The range bar charts are a different type of chart, right? So your regular traditional charts are going to be minute based. So the 1 minute chart, the 5 minute chart, the 10 minute chart, the 15 minute chart, the hourly chart. On these charts, a candlestick is printed at the end of whatever time duration you're on. So in the 1 minute chart, every 1 minute, 5 minute chart, every 5 minute, hourly chart, 1 candle represents 1 hour. The range bar charts are slightly different. They're kind of tick-based charts where it's more based on movement. So for example, if I'm trading on a 10 range chart, I'm going to get a candlestick that prints each time the market moves out of a range of 10. This could happen in 10 minutes. It can happen in 10 hours. It can happen in 10 seconds, right? You never know. But the specific range bar duration range that I was trading on was a lower time frame based one. So these candles were printing pretty quick. And I developed this very simple strategy where I was just basically, I I had a risk reward that was slightly in my favor, and it was more of a frequency based strategy, meaning that I had a very slight edge in the market. My let's say my risk reward was like I don't remember the actual numbers off the top of my head, but like 1.05 to 1. But the idea was that, hey, because I'm on such a short time duration or chart duration, I'm going to bang out these trades consistently, this many a day, and it'll be one of those kind of, whatever the opposite of death by 1,000 cuts is. Money by 1,000 pennies? I don't know what it would be, but you guys get the point. I had a very small edge, and I was just churning this edge over and over and over and over again consistently in the market. And after spending hundreds of hours testing, including like live testing as well, it worked pretty damn good. I was excited. So at this point, this is where I made a crucial mistake. Normally in the process, after I back tested and it works pretty darn good, I would then go into a demo trading session where I'd kind of get my feel for it in the market and blah, 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 blah. But since you can't really back test the range bar charts, a lot of my studies and a lot of my testing data was done during the live market. So although I wasn't technically demo trading it, in my mind, what I convinced myself of at least, is that I was observing it in real life and I was tracking trades in real life, not actually taking them, but tracking them in real life. And that served as my demo trading. And in reality, I was probably being a little bit lazy. I was a little bit excited about getting started because I had this new thing that can make me money and I want to make money as quickly as possible. But I skipped that demo trading phase because I just figured that I already did it. Like, let's just start trading live. I'm already a successful trader. Let's do it. And what I noticed in my live trading was that one, I wasn't getting filled at the right location, mainly because the price chart moved so quickly that by the time I pushed my order, I was getting slipped, right? I would miss a little bit of the move. And by a little bit, maybe I'd miss it by like 2 pips or 3 pips. But again, on such a small time frame, this was a massive amount. Add to that, I was also getting slipped by the spread because now I had to pay the spread. I had to pay my broker a pip, 2 pips, 3 pips on each trade that I took. So pretty much what I was doing was I was missing my supposed entry by probably about 5 pips on each individual trade. And guess what? I told you I had a very, very small edge. This 5 pip difference was the difference between me having that small edge and me just trading like a neutral strategy. And well, long story short, it ended up not working because although it worked theoretically on an account where everything was perfect, in real life, it did not work because of the slippage and the spreads. And that is something that I don't know if I would have found out during demo trading. I probably would have. The spreads wouldn't have been a deal, but I would have found out about the slippage, and by slippage, not slippage, but the time between price movement and me hitting my order. So me hitting my order, because I had to use market orders for this strategy, me hitting my market order and where price was at by the time I hit that market order. If I would have taken the time to demo trade, that would have been a red flag. Like, wait a minute, I'm getting into these trades consistently a little bit late. Maybe I need to revisit this. So that's one reason to demo trade, to make sure that your system that you've back tested actually works in the real live markets and that you're actually able to execute it. Because many times we have all these cool ideas, but we can't actually do it. The second reason you should demo trade comes from another question I just got from a trader who has just finished back testing a portfolio of 2 different strategies. And he said, hey, something you and Jason say all the time is that you should start with one strategy, right? Start simple, one strategy, one pair, or one strategy, multiple pairs, and like make sure you master that before you move on to anything else. And that's something in general that we say to most traders. And the reason we say that to most traders in general is because most traders aren't good. I don't know a way to sugarcoat it. Most traders struggle to be good. It's very, very hard to be successful. So you want to focus on being successful at one thing before you could be successful at another thing, right? It's like, when I coach the athletes, I give them one thing to focus on. I'm like, hey, just focus on your arms. But coach, I got to do my arms, my legs, and my this and my that. I'm like, yeah, but if I give you 4 things, you're going to forget all 4 of them. If I give you 1, there's a shot that you might remember 1. So let's just focus on one thing. Then we can work on the second thing later. And it makes much more sense that way. But the reason, or what I told the trader was this. I said, hey, you don't have to be afraid to start demo trading both. He was asking about going on the demo trade. And demo trading is amazing in this way because, the reason that we say trade one and don't start with many is because you don't want to become overwhelmed. If you become overwhelmed in the markets, you start missing opportunities, you start misreading trades, you start making all types of mistakes, which ultimately end up in you losing money. So it's easier to start with one and limit those mistakes. But everyone's different. Who knows if you're going to be overwhelmed or who knows if you're going to handle it perfectly, right? That is going to be on a trader by trader basis. So in your demo trading, this is your chance to see, can I handle trading 2 strategies? Can I handle trading 2 strategies on this many pairs? Am I going to get overwhelmed or am I completely comfortable? And this will be kind of the last level before you reach the final boss, which is trading live, where you can say that, hey, I demo traded this for a blank amount of months and everything was good, didn't make any mistakes. I stuck to my routine, my ritual, and it worked out fine. Or you may say to yourself, oh crap, this is too many. I can't do it. I did that with my day trading as well. I did my day trading and my swing trading, but specifically my day trading, when I went from swing trading to day trading, I was swing trading like 20 pairs, right? Way too much, but I learned that lesson later. When I went to day trading, I'm like, I'm just going to day trade because I use the same strategies as a day trader. I'm just going to day trade 20 pairs as well. Big mistake. Oh my gosh. I mean, I did have a lot of computer screens. just saying. Just haven't said it in a while, so I'm just saying. Had a lot of computer screens, right? So I was able to watch all of them. But can you imagine watching 20 different pairs on like a 5-minute chart and like my eyes are like bouncing around like I'm on some type of drug or drunk too much coffee? I'm just like, right? I'm all over the place. And it ended up in me like missing a whole bunch of opportunities. And, during that demo traded period, that was my experience where I was like, yeah, nope, can't do this. And I've ended up settling on kind of my magic number, which was 6 at the time, or 4 to 6 at the time. That was enough for me to kind of still be responsible in my trading, but have a big enough portfolio that I got a good amount of action on a regular basis. But it was the demo trading process that allowed me to see that. I can only imagine what the damage would have been if I went and just started trading live on demo or live as a day trader with 20 pairs to watch. It would have been bad. So those are 2 reasons that demo trading exists. Demo trading isn't there to hurt you, right? It's crazy, again, how so many traders think or used to think that demo trading is there to punish you. It is there to protect you, right? It is there to ultimately allow you to see the dumbness that you may be doing before you do that dumbness with live money. So my advice to every trader out there is follow that process correctly, learn how to trade, develop a strategy, backtest that strategy, demo trade that strategy, and after and only after all those boxes are checked, trade live, because you never want to be in a rush to lose money. Hope you guys enjoyed the episode. Remember, leave me a rating and a review if you haven't done so already. It's a great way to support the show, and I will be forever grateful. And I'll see you guys next episode of the Trading Coach Podcast. Make sure you go back and listen to the archived versions as we cover tons and tons and tons and tons and tons of topics. So if you're looking for something specific, just type in what you're looking for, followed by Trading Coach Podcast, and something will probably come up. If not, I'll make a future episode about it. All right, until next time, plan your trade, trade your plan. Take care.